Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 20th, 2024. And in this week's episode is a follow-up episode from last week. So last week we went around and I showed you what do I do when it's time to deploy more capital and how do I look for a trade. And I took a trade on Discover Financial Services, DFS. And in this episode, we're going to go ahead and recap how that trade worked out and where am I going next. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders. Love to hear what type of content you want to hear about and love to hear what you're out there trading. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is released in an audio-only format, so wherever you get your podcast, look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And this week, I want to take a look back at last week's episode. So I went on the hunt for deploying new capital, and I went through my thought process on how I screen for things and where I decide to put my capital. And I had narrowed down into Discover Financial Services. It actually fulfilled both a long-term play and a short-term play. And I want to kind of recap where that stands. So it was an earnings week last week for Discover Financial, ticker DFS. And it fit both my criteria for both a short-term earnings trade as well as a longer-term theta burn play. Now, longer-term in my book is just 30 days or about a month expiration. And so I actually entered both trades the Monday following my recording for the week of earnings. And I put a trade on that expired that week. And I also put a trade on that expired at next month's expiration. And I want to kind of recap how that panned out. But if you want to actually see the setup and see the thought process on how I selected this underlying, I'll put a link right above to last week's episode. So go ahead and click on that. You can walk through there. It talks about how I screened for this, how I arrived at this, and how I decided to open up this trade. So one of the things when I like to recap a particular trade, there's two ways that I like to look at it. I like to look at the chart as far as, I call it the flappy bird chart on where the price action actually took the underlying, and I kind of block where my particular strikes are to show you where my, losing money or basically kind of in the money trade is and where the perfectly beautiful target prices of there. And then I also like to look at the table of kind of the profit and loss of what I collected. And then I like to always kind of balance that as far as my return on capital. So let's go ahead and start with the return on capital chart or the table. And this will allow me to just briefly recap the trade that I had took. So Discover Financial Services fit all the bill. We were basically looking for extremely extended volatility, and then we were looking for a short-term earnings contraction. And that's really where we kind of got into this long-term and short-term. So Discover Financial Services had earnings last week. Earnings are very often a binary event. And after the binary event, you will get very sharp volatility contraction. And so my trade is to look for very, very extended volatility, sell that volatility on the premise and high probability that we're going to get the volatility contraction, and we're going to stay within the expected move. If so, basically this thing becomes worthless after the binary event, and I get to capture and keep all the profits of selling that volatility. Now, Discover Financial Services also had very good volatility on a longer term trade. And so there was basically two options that I took here. I did a short term and a long term. Both of them went about the same strike. When I say about the same strike, I mean the same delta value of the strike. And so on Monday, October 14th, I opened up two positions. The first one expired that Friday. So Discover Financial Services had earnings after the bell on the 16th, which means my target was to sell premium before the earnings announcement and then close the options right after the earnings announcement. Now, the only options that I was targeting to close were the options that were going to expire that particular week. The reason for that is because that week was the week of the binary event. That week is going to see the most volatility contraction. And then the other piece was to open up a longer term play on Discover Financial, also selling volatility because it was really at all-time volatility high. And the idea is that volatility will continue to decay and contract beyond earnings slowly, and that would give me this longer theta burn. And the reason that I was able to take that as well is because, again, that extended volatility. Now, I don't often do both an earnings announcement and a longer term trade, but I happen to be looking for filling both things in my portfolio. And both of this and Discover Financial Services look good. So the second piece that I opened, I did 2 contracts of the shorter play and 2 contracts of the longer term play. So the longer term play, I went out to the next monthly expiration because actually the 18th was October's monthly expiration. So I went out to November 15th, which is November's monthly expiration for the longer term trade. I targeted about 20 delta for both of these trades. Now you can see the strike price was different. So the 20 delta for the options that were expiring that Friday was about 135 put and 155 call. Now, the same 20 delta, of course, longer out in time, had a wider range, and it basically was a 130 put and a 170 call. And I was able to collect about $3.36 for the short-term strangle price, and I did 2 of those, so I collected $672 for that. Then the longer term was going for about 5.25 contract, and so I did 2 of those contracts, collecting about $1,050. So I'm kind of midstream, so I guess this isn't really a full conclusion because I really only closed out the earnings piece of this. The longer term Discover Financial Services is still on, but I'll show you in the Flappy Bird chart. It's looking pretty good. So immediately after earnings on the 17th, when the market opened, Discover basically went nowhere. So it stayed perfectly, hated a little right down the middle on my Flappy Bird chart, and we'll bring that up in just a second. But I was able to close out the strangle, the shorter term strangle, the ones that expired that Friday, for 36 cents a contract. Now, I could have left that on into expiration, but that's not really my style. The reason that I don't really like to do that is because as soon as the earnings come out and you get that volatility contraction, and so, I mean, you can see within a matter of 2 days, we went from $3.36 a contract to just 36 cents a contract. And if you think about what it means to leave that on, anything can really happen with price. Yes, the probability is not there, but, at that point, you've already burned down $3 in premium, like overnight. Okay. So why would you want to leave that, put at risk that $300 per contract or $600 in my case, simply to make another $72, where you can close that out, put it back in your wallet, and look for other capital deployments. You've already got a tremendous volatility contraction. And that's really where my head is at, I view that as leaving that trade on, even though it's just for 2 more days, the 17th and the 18th. I'm basically then flipping the script here, and I'm putting at risk that $600 simply to pull in 72 more. And if that's your bag of donuts, then go for it. But for me, I might as well take the profit off the table, pull that money, that buying power back, and go look for another thing to deploy. So you can see on there so far in this trade, I then paid $72 to close out that short-term strangle. I still have the longer-term strangle open, and I likely will close that out once we get significant theta burn down on that. But if you look at the costs and premium that I've collected, I've basically collected about $1,650 in premium. Now, I will end up paying some premium to close out that longer term, so it won't really hit that return on capital that you see there. This particular trade took up about $4,100 in buying power. And if you take the amount of money that I have collected thus far, divide it by that buying power consumption, this gives you your return on capital. So basically, I had to sequester that $4,100 out of my trading account, can't put that money to work somewhere else. But that $4,100 so far has yielded me $1,650, and that basically puts me at about a 40% return on capital. Now, this will come down a decent chunk because I'm going to end up paying money to close out that longer term strangle. But at the end of the day, we're probably only going to come down 5 or 6% return on capital. So this is still an excellent, in my opinion, return on capital for what I consider a lower risk trade. And when I say lower risk, I mean a high probability of kind of working out in my favor. But let's really hop over to this Flappy Bird chart, because I think this is the other way to really visualize this. And this visualization here is kind of, so I've got this on 4 hours. I can kind of zoom out just a little bit to show you where these blocks kind of end. So these are 4-hour candles, going back here and Discover Financial Services back to July. And I've got 2 blocks here. I've got this block that's a little bit tighter, kind of going into the earnings announcement. This was my shorter dated strangle. And so the first chart that you see here, the first edge, is really where I open both of these trades. So the longer block that extends out there, that is the one that goes till November expiration. And then provided that we hey diddle diddle right down the middle on this particular case, this is as long as we stay between these strikes, what I call a Flappy Bird chart. We've got the candles kind of going through the tubes there. This really will be 100% winner. Now, I won't really take it all the way to expiration. I'm going to really look for, 50, 60% of my premium collection, and then I'm going to go ahead and close it out. But you can see right here is where we had earnings, and we got this big candle move here, but effectively we ended up going nowhere, which is the most perfect outcome when you're selling a strangle, right? The selling a strangle means you're saying we're not going to go above the price up here, and we're not going to go below the price down there. We're going to stay somewhere in the middle. And as long as we target that really, really extended volatility, which is a key component, if we do not have that abnormal extended volatility, I don't take these trades. And the reason is because that pushes the expected move farther and farther. And historically, probabilistically, all of those things, that volatility is always overstated, which means there is a very good chance that we will not exceed those targets, which of course exactly happened here. And so this is just a matter of letting this Flappy Bird chart kind of keep going out there. The shorter term trade is closed out. The longer term trade is going. So that brings us to the end of this week's episode. Like I said, a very quick episode. If you combine this with the previous week's episode, you get kind of the full picture of what did I do to find that Discover Financial Services and decide to enter that trade. And then this week we kind of showed, hey, this is how Discover Financial Services panned out. This is the bread and butter of everything that I do. I mean, I'm going to go out, I'm going to look for more volatility to sell. We got some huge earnings coming up next week. But this is very, very simple methodology and mechanics for me. Look for the extended volatility, sell the extended volatility, look for that short-term contraction in volatility, or the longer-term slow theta burn of starting with super extended volatility. Does it work out all the time? No, of course not. But it is probabilistically works out in your favor, and you really have to be kind of okay with assignment on the top or bottom side. And I talked through that in the previous episode where we were screening for this. That was certainly an outcome that I was okay with. It's not the ideal, but it is a potential outcome. And when you enter trades, you really need to understand all the aspects of what might happen as that trade progresses. And I laid all those out in the previous episode. Of course, it happened to play out in the most idealistic way, where you got absolutely no price movement after the earnings announcement. So the unknown is gone. The volatility completely evaporates, and you can buy back what you have sold for pennies on the dollar, and booking a very nice gain. And that money goes back into your portfolio to recycle and go out for the next trade. So hopefully that is a nice full circle conclusion for you guys, closing the loop. And I hope that you are out there looking for the trades that fit your trading style and your methodology, and you're having good luck doing it. So good luck out there. And remember, think outside the block.